Our guest this week is Jenny Fielding, co-founder and general partner of Everywhere Ventures. Jenny's a pre-seed investor with a fascinating background. She's a founder, lawyer by training, has lived in 12 countries, visited more than 100, and ran Techstars New York for many years. She's also the author of Venture Everywhere, a book which comes out in March. We talked about Jenny's strategy, why venture doesn't scale, and how Everywhere is navigating the seed and AI markets. Please enjoy. Jenny, thanks for coming on the show.
Thanks so much for having me.
So your site says you're a generalist and your name firm is Everywhere Ventures, which sounds very expansive, but you do have a sweet spot. And maybe just to get started, can you tell listeners about what your focus is?
Yeah, so we're called Everywhere Ventures because we believe innovation's everywhere and we want to be where the best founders are, wherever they are. And so as you can imagine, our portfolio is quite diverse. But we also feel that geography is becoming a lot less important in many ways, or maybe very important, however, you look at it. But oftentimes we'll meet a founder and, one founder will be in Austin and one will be in Indonesia and one will be in the UK. And it's like, well, where is that company based? So it might be a US C Corp, but, the company is everywhere, right? Or is in different places and their customer base might be diverse as well. So we believe, we're pretty excited to be part of this kind of opening where geographies are becoming, less important and we can really focus on what matters, which is really founders and founders finding interesting markets to sell into. So we're generalists. I think that what's interesting is that our deal flow, we're not, outbound, so we're not thesis driven, but our deal flow comes from our community of founders and operators who've all invested into us. So we have 500 founders and operators that have become LPs in our fund. They're our eyes and ears on the ground, and they're located around the world. And so our deal flow is really amongst all those interesting companies that are coming from that network.
That's awesome. There's a chicken or the egg to that, right? Which is the bigger the LP base in the network, the more deal flow, the better the deal flow. Where, I guess if you go back in time, like my kids ask me sometimes, like chicken or the egg, literally like, which came first? Answer the question, Papa. Like for you, which was first? Coming up with the firm, building the network? How did they go in tandem?
Yeah, well, as many people know, I spent almost 8 years at Techstars. And so as I was building there, I was developing not just the companies that I was investing in, but all the mentor pools and kind of like the larger Techstars ecosystem was really chock full of founders, operators, former founders, people that had been in and around startups. So I started, very, organically many years ago when I started at Techstars 2014, kind of building on what I'd already built as a 2-time founder myself. So when I decided to start the firm, I'd already had kind of hundreds of people that I'd interacted with, quite frequently. And they were kind of part of my larger ecosystem that I tapped into. So I'd say they kind of came hand in hand, but I built the network over, let's call it the last decade.
What does pre-seed mean to you? It's a very loose definition.
Yeah, for us, it's first money into the company. So, first call it institutional round. Usually the round sizes are between 500K and about 2 million. And the companies are raising at, reasonable valuations because they're all pre-product market fit. So really this money is being used to help them find a buyer for their product.
I've heard you mention reasonable valuations at different interviews. Can we talk about, some investors run towards the heat, folks. Some people are more focused on valuation. Obviously, it's something you're mindful of. Can we hear more about that?
Yeah, we try not to focus on it too much. It's like, well, does it really matter if this deal is priced at a 6 or an 8 or, how does that impact? But if you take a step back, we write small collaborative checks. So our average check size is about 250K. And, for us to have a 250K check into a deal that's 25 million, it's just very hard for us to make the math work. So we're very math oriented, I'd say, less, valuation. Every point really matters, if that makes sense. So again, it's like, it doesn't really matter if it's, a 6 or an 8, but it does matter if it's a 6 or a 25, just because we write one collaborative check and then we, like alongside the founders, have to kind of ride that down in the next rounds. So we have to be sensitive to that and how our model can work. And when it works, it really works. So we, in our first fund, had one $50K check into a company that returned our fund multiple times. And so that we were in, it's a multi-unicorn, and we were in at about a 7 million valuation. So when if we'd been in at the 30 million round, like actually it wouldn't return our fund multiple times.
How much are you focused on? Well, I'll rephrase that. How much of the strategy is focused on follow-on?
Yeah, so we write one check at the pre-seed, and then we ride our ownership down with the founders. So we're very much aligned with the founders. And then for our pro rata, we do SPVs. So we're able to offer our large LP base that I mentioned, those rounds at a follow-on. And so we find that, kind of everyone wins in that situation, because our LPs can get, another bite of the apple into areas that they like. We're very aligned with the founders because we're writing one check. There isn't, wow, is there more money coming? And so we have set it up strategically.
So feedback from LPs, they really like the pro rata rather than you trying to use the follow-on through the fund.
Yeah, I mean, most of our LPs are not large institutions. They're other high net worths, other founders. As I mentioned, we have, a few family offices. And so if they see something that they'd like to double down as the A's and B's start coming together because it's a strategic area for them, or an area where they have a lot of knowledge, then it's, it's easy for them to get access.
So I want to come back to that and the investing part, but why don't we talk about your book? You've got a new book coming out. Curious to hear more.
Well, it's not your typical business book, which I think might come as a surprise, but it's called Venture Everywhere. And it's 12 chapters, 12 founders, 12 countries, and just a really kind of journey through entrepreneurship, but not from the lens of Silicon Valley, from innovators that have been building in ecosystems, that seem far-flung to us. And my experiences in all those places, I've traveled to 100 countries, I've lived in a dozen, and I've really, gotten to, see and meet people on the ground. And so it's kind of a celebration of those founders that have pioneered, even when they've come from small towns and rural places, around the world, but somehow they've built these really amazing companies. And so, the book is about some of the characteristics that you can kind of thread through these stories.
What are the first ones that jump to mind?
Well, I call it the everywhere mindset. So I think oftentimes when you grow up in the US, we can be very US focused. And I think some of that's just changing by the nature of our world. I mean, I think, when I took my first jobs out of college and whatnot, most of my colleagues probably were living in the city that, that I was in, or I was interacting with more local people. I think now, if you don't have a teammate who's international, I think that is quite weird. And so I think we all need to figure out how to have empathy, how to, develop our skills so that we can work, in this new global kind of paradigm that we're in. So really building that global mindset from day one. And I think if you grow up in a small town in Pakistan, or, a rural place in, in South America, you kind of have to have that from day one. And in a way, we're, a little bit spoiled in the US, where there's so much here that we can kind of focus on, just the day-to-day US living. But I think that if you're going to be entrepreneurial, and you're growing up in places outside of the US, you have to kind of cultivate some of that skill set early on.
Given the growing LP base, the growing brand, like your personal brand, the firm, you got a book coming out. How do you think about scaling up and systematizing in a way that you can work through the volume of deals that must come your way?
Yeah, it's funny. I'd say now, you're going to laugh at this, but probably at least 50% of the founders that I get introduced to, I don't know before, say, oh yeah, I follow you on LinkedIn or Twitter. So I think social media is actually a powerful, and it seems, kind of obvious, but it is a powerful way, not just to extend your brand, but for people to, for founders especially, understand, is this a type of investor that I want to be talking to? Or they get to learn more about what's important to to the investor so that there's a better match at the beginning. And so I often have these conversations where a founder will say, I heard you on this podcast and you said something that resonated, and we can like start the conversation from there. So I do think that, social media, and it wasn't purposeful. It kind of just happened over time. Again, all these things just take time to build. So over the last decade of me investing, just bit by bit, by posting, by being on, shows like this, you kind of get the word out there. And that's been, unexpected, I'd say, but quite helpful. We started the firm in 2018, and we looked around and we said, okay, what is it that venture capital does really well, how it is formulated right now? And so things like governance and making fast decisions, and a lot of that was like set up well by venture capital funds. And we looked at angel groups and we're like, what's nice about angel groups? And, the community and the grassroots and the personal relationships that, many of the angels have. But what's like doesn't work about angels, and it's the timing, the no governance, like some of these things. So we kind of came up with this idea early of like, can we like deconstruct how investing works and kind of pick and choose what we think are the fund of the future. And so one of those things was, can we go through a whole diligence process from sourcing, diligence, like investing, all of that. And the partners, the GPs actually never really get on the phone with each other about it. Could we do this all async? And it was kind of an experiment. Like, I don't know, does this actually work? So in 2018, we started building tools, using very simple tools, whether it was Slack or Airtable or these things, to build almost like an autonomous fund. And so that's how we've been running it, where we go through the same processes as a regular venture capital fund, but we're able to do things kind of async and through a lot of automations that we've built over the years that help us, get through our deal flow, diligence it, and ultimately make investments in a very efficient way.
How does your relationship with founders evolve over time?
Because we're the first check-in, I'd say, I feel like my obligation is like to help them get that priced seed round done, right? For a board to come together, for, other institutional investors to get on the cap table. And so at the beginning, oftentimes there's a lot of support, I'd say, on the fundraising side and kind of the basic building blocks of a company. And that might involve like a lot more back and forth and a lot more touch points. And I feel like as the companies kind of progress, I go from, that kind of resource support to someone who becomes like much more of like a cheerleader for the company. So I have companies now that are unicorns. And, I just think it's so awesome when I get to speak to those founders and, they still call me about this or that. And it's like, I just get to kind of root from the sidelines. So, I feel like my goal is really to help them launch, so to speak, and, get them to that next round where then I can kind of put my founder hat back on and say like, hey, this is what I experienced as a founder, or, here are some, things that worked for me, much more as a friend than as an investor, if that makes sense.
What's your view of the seed market today and the direction that's heading?
It's a good question. I think, we've obviously had a huge reset, and some would say maybe even reset a little bit too hard. I think it's hard to raise a seed round right now, especially if you've raised a pre-seed. The metrics that VCs want to see have really skyrocketed, and so we're seeing that there's kind of this gap. You're able to raise the pre-seed on vision, but you can't raise the seed on vision. You really need to like supercharge with metrics. So if you've raised $1.5 million, the expectation is that you're going to get to, a few $100K ARR with that. And so you really have to move fast with that money. And so that's been kind of an interesting shift. Whereas, a couple of years ago, I feel like you had two bites of the apple. You kind of raise the pre-seed to get yourself going. And then you still had this like another chance to hit product market fit. And now you're kind of expected at these seed rounds to like have a lot figured out. So I'd say, that's been an interesting shift. And where things are going, I don't really see us rolling back too much in most verticals. I think that is kind of the new normal. And it really just depends on like how long you've been in business and how much money you have raised thus far. So I always tell founders when they raise a pre-seed, think of that as your last money. And what will you do with it? Will you get to the metrics that the market thinks are valid to raise the next round? And I think, a lot of founders are kind of shocked by that. They're like, really? Like, I'm supposed to get to profitability on 1.5 million? I'm like, you got to know the levers in your business. So if you're not able to raise, it's not end game. It's really like, okay, course correct and, go into a different model.
What's the biggest challenge that you've had scaling up the communities that you have?
Well, communities are hard. I've been building them for a long time. They take a long time to build. It's step by step, and then they're very easy to come crashing down. So you have to just be very careful. I think that we've been quite lucky in that we didn't try to start our community and just have it all built out. We've been around for 7 years, and so we've kind of been building it step by step. And that's been very helpful because I think the key to communities is intimacy and trust. And so once you lose those, like the community gets too big, it's no longer relevant and intimate, and you lose trust. So I'd say that balance is how do we continue adding LPs, portfolio companies, geographies, and maintain the integrity of that. That's a huge challenge.
Does that mean a bigger team, or does that mean you changing your role, or a mix of both?
Not sure a bigger team helps the community. I think inherently it's understanding that our business is not a scalable one. And I think that's where some groups kind of go astray is like, oh, if this is working, I can 10x this by putting more resource on it. And so, I think what we love about what we're doing is it is a cottage industry, and we don't need to scale it to be successful. And I think that's one of the interesting things. Our funds are small, and everyone says, well, why don't you raise $100 million fund? I'm like, well, I can't do the work that I love, writing 250K checks with all of this money. Like, there's only so many checks that I can write and so much time that I have. And I think that's fine. I think this whole idea that everything needs to be scalable. I mean, we're not a software company. The rule of 40 does not apply to us. We're just a venture capital firm. We're based on people. So we don't really have ambitions to scale this heavily, but obviously every year we have more portfolio companies, more LPs. And so we have to gradually integrate those people. But ultimately, the judges are the founders, right? Do they still get value from the community, from our Slack channel, from our events, And if those are high quality, then, they can expand slightly.
For investors writing small collaborative checks, are you finding fewer people responding to emails on that front, or less competition, fewer people writing those checks?
Yeah, I would start by saying like we never felt like those are competition. In fact, we love having co-collaborators and co-investors, and we syndicate almost all of our deals with a great group of people. And we're on the cap table, as you and I just found out, with each other.
Yeah.
So it's awesome, having more capital for founders. Ultimately, we're founders and we wear that hat pretty heavily. So more capital at the early stage, I actually think is a good thing. In 2021, so much capital was raised. Everyone thought they wanted to be a VC. And turns out like there's some good things about being a VC, but it's not, all roses, and everything isn't all up and to the right. So I think there was a little bit of a realization that, wow, raising capital in a down market is not that easy. Managing a portfolio that everything isn't going, swimmingly well is not that easy. And I think some people, just kind of decided that they wanted to go back to operating, or that they wanted to move on to other things. And I think that's kind of natural. So I think the fall off is probably okay. I do, think that there's some great emerging managers and micro funds that just got caught in really bad timing, right? Like they had to raise last year or the year before, and people were like, "Well, you don't have metrics yet, so what are you raising? What are you raising on?" And I think that's unfortunate. And I hope that some of those funds can figure out a way. And I think some of them have, of slowing down their pacing or raising from alternative sources, or kind of just maybe going quiet for a little bit. But I think, some of them will come back. So I'm hopeful. I'm not one of those people that, thinks this big reckoning is actually good for the ecosystem. I think on the, from the capital sloshing around, at the A's and the B's, like, honestly, I think that's better of everything kind of coming down a little bit and getting a little bit tighter on cash there. But at the early stage, I mean, we want company creation. We want people out there building businesses. I think that's the most exciting thing.
It wouldn't be a venture podcast if I didn't ask you about AI, but specifically want to ask about how you think about AI in the context of valuations. So being price sensitive, you look at carded data, and anecdotally you would see this, price round valuations for AI companies are roughly a third higher than non-AI, I'm using air quotes, companies. Does that create an issue with you as far as access to rounds and at pre-seed where these valuations are so rich? Like, are you having to bend a little bit in some situations, or are you just kind of walking from some of these deals because the area is so hot and you don't want to chase on price?
Yeah. I mean, the truth is we don't really invest in AI in the same way that we didn't do crypto, and that we don't really do, a lot of these infrastructure plays. We invest in people building companies, and we expect them to pick, the best technology for them. We don't necessarily think those are AI companies because they're using AI tools or because they use automation to deliver, a service. So in terms of like infrastructure AI companies, it seems most people don't have access to those. Those are, being done mostly on the West Coast and mostly with people billion-dollar funds. And I think our companies can benefit from all that capital going into a lot of open source projects. So I think, it's not actually such a bad thing that Microsoft and Google and all of those folks are snapping up companies, investing in companies, and ultimately building, great AI products that we can all use. I think it's incredible. But as a thesis, we don't focus on AI. We focus on verticals that, we think have staying power for the next, 10 years, that are helping with kind of what we call the resilience economy. So whether that's healthcare or finance or, climate, we're looking at the underlying technologies and software layers that can help those companies become more resilient.
Does the election change anything for you as far as some of those sectors?
No, no. I mean, I think the election, whatever side that you are on, I think we can all agree that, if the economy does well, the M&A market, keeps on going and gets more favorable to startups, and the IPO market opens as we think it is, it should be helpful for all of us. And in terms, if you're referring to climate, most of the climate companies that we know have been mostly focused on Europe anyway, because the regulatory tailwinds there. So I think that will, continue to be a trend. But I think we're going to see more private capital actually go into climate if the government's not going to support it as much.
What's a conventional view in venture that you think is BS?
That there's too much money at the early stage. I mean,
Let's
so
hear it.
many people just talk about, there's too much money at pre-seed and everything's over. I mean, we want founders starting companies, right? And so we want everyone. We want students. We want people starting companies, and they need some cash to do that. Not everyone, is financially able. So I like to see money at the early stage and have lots of co-investing friends.
We were talking before the show. You were in Australia recently. I lived there for a number of years, so I got a soft spot for it. And in the spirit of plugging a great country, what interested you about going down under?
Yeah, we have been lucky to make about 10 investments in founders that are kind of in and around the Australia ecosystem. But getting back to my original point, we have, of those 10 companies, I'd say only a couple are actually full-time in Australia. It's one founder's in San Francisco, one's founder's in Melbourne. So really kind of a lot of split teams. And I think that's what the Australians are just so brilliant at, is that they have this everyday mindset that I talk about in my book from day one. They all live abroad. They all understand many cultures, and it's just fascinating. So I love visiting them because I think they, even though they're so far away from the US, they have like this incredible worldview, and they're just ambitious as hell. I mean, I love the Australian founders that we've been able to meet.
Well, if someone out there is a founder and they want to get in touch, what's the best way for them to do that?
Yeah. Follow me on Twitter, J.E. Fielding, or hook up with me on LinkedIn. Very easy to find. I'm always at events, always doing lots of things. So excited to connect with founders, pre-seed founders. So.
And how about your book coming out in March?
March 4th, Venture Everywhere. I think you'll be surprised. It's a very fun journey through some great ecosystems and just some very inspiring founders that are not maybe your typical ones. So hope you'll have a read.
Awesome. Well, Jenny, this was fun. I appreciate it, and thanks for coming on.
Thanks so much, Joe. This was great.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.